Hello everyone, welcome to part 2 of the week 4 lecture. The focus of this week's part 2 of the lecture is on COSO yet again, in particular on elements of the enterprise risk management framework we outlined in last week's lecture, and how COSO has sought to position this framework in the context of managing environmental, social and governance risks. So we have the broad ERM framework, which COSO now has taken and applied to the specific issue of ESG risks, given the rising importance and concern about these risks I outlined in part 1 of this week's lecture. The title of their document is Applying ERM to Environmental, Social and Governance Related Risks. And what COSO does, it takes the framework we came across last week in part 1 of the lecture and simply aligns it with various ESG risks. What I'm going to do in the lecture is unpick some of the ways in which they've advised organizations to manage some of the risks that are deemed to arise in the area of ESG. Now, what are these ESG related risks that COSO wants to be managed? Well, they're the ESG risks and or opportunities that may impact an entity. And what's really important about that definition is the word impact. It's the impact they have on an entity that is deemed to be important. And not only are they looking at risks, because risks can be turned into opportunities. And that's something COSO is keen to emphasize as well. We don't have any universal or agreed upon definition of these so-called ESG related risks. They can be called sustainability related risks, non-financial related risks, or extra financial risks by different bodies. So every entity will probably produce its own definition, depending on its business model, its markets, its products and services mix, its mission, its vision, etc. So there's not a static definition out there. But COSO has one firm view, though, on the notion of ESG risks. And they state, don't start thinking that ESG risks are the so-called black swans we alluded to last week. They state, in the business world, the evolving landscape means that ESG-related risks that might previously have been considered as black swans are now more common, much more common. And they come about much more significantly, much more commonly within organizations, and the impact on organizations much more. So you can't say these so-called ESG risks are totally unexpected and difficult to prepare for. They're actually much more common now, according to the COSO framework. Despite this broadness around ESG, COSO does try and give us some specific definitions which allow us to look in more detail at what ESG might mean. And they talk about environmental issues as being issues around climate change, natural resources, pollution and waste, and also environmental opportunities. So the contribution an entity makes to climate change through greenhouse gas emissions, along with its waste management and its energy efficiency, might come under environmental. Under social, we're dealing with issues around human capital, product liability, stakeholder opposition, and social opportunities as well. But again, we're talking about human rights issues, labor standards in supply chains, child labor, etc. Things like this that might be impacting on a company in this area. And governance relates broadly to corporate governance and corporate behavior, something we've alluded to quite generally in the course so far. And in our definition of corporate governance in week 1, we alluded to the broad definition or broad conception of governance that would be comprised within the ESG definitions which COSO tends to promote. They also state in their overall framework that organizations such as the Sustainability Accounting Standards Board and the Global Reporting Initiative, among others, have a list of issues they'd lean to come under ESG. So the broad area of ESG continues, but you have all of these frameworks and these bodies which will indicate to organizations which areas they should be reporting on, and by implication, which areas they should be trying to manage in terms of risk. Breaking down this ESG pillar in some way further, you can look at the themes which COSO talks about managing in a risk management process. So in the environment, we have climate change, natural resources, pollution and waste, and opportunities, which I mentioned earlier. And then in the context of these four themes under environment, you have issues like carbon emissions, carbon footprints, raw material sourcing, electronic waste, all of these issues that need to be managed because they may pose risks. In the social domain, we have issues like human capital, product liability, stakeholder opposition arising, and some opportunities. In the area of human capital, management of labour, health and safety, supply chain labour standards come forward. Then in governance, not only corporate governance generally, but also issues around corporate behaviour, business ethics, anti-competitive practices, tax transparency. They are all issues which may impact on an organisation and its ability to do business if they become serious. But they're all potential risks that COSO says have to be managed within an ERM risk framework. And so where do these risks come from? Well, COSO claim that if you look into the past, you can see many organizations have experienced very serious ESG-related impacts which they've had to deal with. Now, some might argue these might be akin to black swans, but others would say they're not. They're risks which organizations had in their environment, which they should have managed much better in the context of their overall business. So back in the 1990s, Nike was accused of employing children and paying workers less than the minimum wage. That blew up for it and became a major reputational risk issue among consumers. Mattel, the toy manufacturer, recalled almost 1 million products in the 2000s due to lead paint contamination in its products, which wasn't picked up by any management system. BP had a major disaster on an oil rig, the Deepwater Horizon oil rig, which exploded back in 2010, killing 11 workers and injuring 17, and also creating one of the most major environmental disasters along the US coast in history. But again, investigations there showed that the risk management practices in the area of health and safety and environmental management were fairly deficient in the context of BP. That was an ongoing case for years. The Rana Plaza factory collapse in Bangladesh in 2013 led to, and think about this carefully, the deaths of more than 1,100 people who were manufacturing various brands, products for sale in our context over time. That's 1,100 people. Again, risk management procedures, major ESG related impact on organizations from that. Volkswagen's recent controversy over the emissions scandal, showing whereby emissions tests were falsified, another major ESG related issue for that organization. Uber faced sexual harassment scandal back in 2017, leading to a movement starting, the /delete Uber movement. And then more recently, Wells Fargo was found to have created millions of accounts in the names of its clients without their permission in order to build up client accounts for particular individuals in the organization. And these are all events which occur, which are deemed to be, according to COSO, risks which manifested themselves for organizations which should have been managed better, particularly at the corporate level. And what COSO is concerned about is that risks disclosure in relation to environmental, social and governance issues have increased, but they're not aligned with the mainstream risk disclosures we saw, for example, in Unilever's report in week 1. Although we might argue Unilever is very clear on issues around climate risk and supply chain risk in its reporting. So they claim there's a lack of alignment between issues reported in sustainability reports or ESG disclosures and the more general risks reported in an organization's risk disclosures. Now, why is this happening? There are a number of reasons. First of all, quantifying risks from ESG related areas is quite difficult, and there's a tendency to want to quantify risk as much as possible. And this makes prioritizing and allocating resources to certain risks much more difficult, particularly when those risks have long-term implications and maybe are pushed out because the actual impacts are unknown over time. But if you go back to Taleb et al.'s argument last week, they're saying, well, these are the sort of risks you need to be thinking about, not in terms of trying to measure them or place them into models, but in terms of putting in place procedures and thinking about what the consequences of these risks would be for you and how you would manage them if they evolved. And that's not about putting numbers on the risks, it's just about managing them in broad terms. Also, COSO claims there's a lack of knowledge of these so-called ESG-related risks across entities. So the cross-functional collaboration that the ERM proposes and promotes doesn't occur. But it doesn't occur particularly between risk management specialists, or let's say chief risk officers, and sustainability or ESG specialists in organizations. They're seen as quite separate. So ESG-related risks are managed and also disclosed in sustainability or ESG reports by sustainability specialists, and they're viewed as separate or less significant than conventional strategic, operational or financial risk, which are managed by these uncertainty experts that are referred to in the Arena et al. Paper in last week's seminar. So to align the enterprise risk management approach, which we looked at last week, with an ESG risk management system, what COSO have done is produce this document on our first slide. And it basically takes the various component parts in the existing enterprise risk management framework and aligns them or considers them in the context of ESG risks here. So governance and culture becomes looking at governance and culture for ESG related risks. Strategy and objective setting becomes strategy and objective setting for ESG related risks. Performance is broken down into identifying ESG related risks, assessing and prioritizing these ESG related risks, and implementing responses. Review and revision is again aligned with ESG related risks. And information, communication and reporting, again, is all about ESG related risks. So what they do in their document is they take the overall ERM framework and then look at how it should be specifically applied to this area of so-called ESG risks. In the context of demand for this, and we saw how COSO responds very well to demand in the Hain and Free paper in last week's seminar. Here's a quote again from Larry Fink of BlackRock. Everyone has the responsibility to manage risk. While many ESG risks will be owned by the ESG or the sustainability team, we want ESG risk management to be a tool that everyone's looking at. Everyone realizes that is essential to an organization. So you can see this demand factor pushing this focus on ERM and aligning it specifically with ESG risks. In terms of governance, within this document, COSO talk about understanding the internal and external environment, and they offer a number of mechanisms of understanding this environment in analyzing mega trends, conducting strengths, weaknesses, opportunities, and threats analysis, looking at the impacts of various risks and your dependency on certain areas in your organization, mapping that out, engaging with stakeholders on where risks might be for the organization, making assessments as to whether risks are material or not. Are they ones you should be managing and reporting on? And then developing resources to try and help you to actually manage these risks. We don't need to know these details, but it's an example of how COSO are seeking to enable organizations to understand their internal and external environment. In terms of governance as well, they look at the issue of how organizations are structured at the governance level. So we have our board or governing body here and all these various risk and other committees underneath that. And then we have reporting to the CEO, executive management, and in the executive management, we'll see in here a chief risk officer. Okay, and then we have the enterprise risk management system reporting to executive management. But here's the sustainability or ESG focused individuals. They need to be, according to COSO, aligning with the ESG specialists. They need to be coming together to be developing specific roles whereby you have risk owners within the management structure. And you need to have advisory councils advising on sustainability and ESG risks as well. But the key point being for COSO, this alignment of ERM with these sustainability or ESG specialists in looking at the area of risk in your organization. In terms of trying to focus on making sure these ESG related risks get dealt with by specific responsible individuals, COSO is very keen on designating risk owners in this particular area. So if we take an example of an enterprise level risk, the risk of increasing raw material prices, well, this can come about because of a change in prices caused by rising energy costs associated with climate change regulation. It's a risk. Get a risk owner, a vice president of the supply chain, and get individuals specifically responsible for supporting that risk owner. In this example here, a chief sustainability officer or a sustainability energy analyst. So you have this chain of responsibility for that enterprise level ESG risk. Another ESG risk is the risk of injury or fatality in operations. Again, the ESG element here is health and safety related considerations. Have a relevant risk owner, an environmental health and safety manager. Have that relevant risk owner supported by risk owners like site managers, making sure health and safety regulations and considerations are put in place on the ground. And a third type of enterprise level ESG risk would be the risk of reputational damage because of poor communication on ESG issues in a supply chain. So again, this is all about creating pressure for greater supply chain transparency around, for example, human rights, especially for large organizations. Relevant risk owner here is your chief procurement officer, individual in charge of procuring supplies and parts for your organization, for example. And again, the risk owner supporting this individual the individual supporting this risk owner should be someone like a chief sustainability officer. So that's all about creating a system of risk owners who are managing specific ESG related risks in an organization. And COSO's ERM framework, as applied to ESG risks, outlines this in great detail. COSO also talks about setting strategy and objectives in the organization and making sure that these strategies and objectives are aligned with assessing ESG related risks. And here it alludes to the integrated reporting I talked about in part 1 of the lecture. And the integrated reporting framework outlines what's called a value creation process. And that value creation process talks about how you take inputs from various capitals, financial capital, manufactured capital, intellectual capital, human capital, social and relationship capital, and natural capital. All these capitals provide inputs to an organization. And those inputs are then processed through an organization's business model. So you've got various business activities. And in the business model, you have a mission and vision, which is implemented through governance processes. And you have lots of risks and opportunities in that process, performance, you have an outlook, and you have strategy and resource allocation. The point being that you have a business model which takes all of these inputs over here, these capitals, and transforms them in some way. And your business activities produce outputs, and outcomes come from those outputs which make a difference to these capitals. So for example, financial capital gets transformed to the business model in some way. Manufactured capital, fixed assets, they also get transformed through the business model and changed. Natural capital related to the environment also gets transformed through the business model. So value gets created in some way in all of these capitals. So in some way value gets created. It also gets destroyed, by the way. So financial capital is influenced, manufactured capital, intellectual capital, human capital, social capital, and natural capital. And so the integrated reporting framework asks organizations to demonstrate how they take existing stocks of all these capitals here and transform them to their business model over here. Now back to COSO. They say this is a really good way of working out your strategy for managing ESG related risks by looking at these various forms of capital and seeing how your business model transforms them. Now, as I said, it can create new forms of capital. In other words, have a positive impact on capitals, but it can also have a negative impact. So natural capital might decline. Social and relation capital might diminish for some reason. Financial capital might decline. But this process, in a very broad form, can help with setting strategy and objectives around managing ESG risks, according to COSO. And in this week's seminar, we look at how this actual integrated reporting process emerged. We talked about risk appetite in the last lecture, and some of you asked in seminars about risk appetite and risk tolerances. Never get too bogged down in those details. Risk appetite very much looked at the broad strategic level. Risk tolerances are the implementation of risk appetite at the operational level in organizations. And an example of ESG risk appetite is taken here from the Gold Coast Waterways Authority. And they developed a risk appetite statement that covers their critical risk categories: strategic, operations, environmental, community, and what they call resilience. And here are some examples of their risk appetite statements which COSO provide us with, related to ESG risks. So you've got environmental risk, and they talk about having a very low risk appetite for activities or events with significant environmental impacts. So a very low risk appetite there, expressed, as with last week, in quite generic terms. They talk about community, and again, a very low risk appetite for activities that amplify the risks associated with peak visitor times. That's again related to the organization. It's a waterways authority. So what COSO does is it takes the broad risk appetite notion we talked about last week, embedded in its ERM framework, and aligns that with a focus on so-called ESG risks in particular. It also looks at risk identification. How do we identify risks? Well, they try and connect the broad business context and the strategy context to identifying specific risks in this part of their ERM risk framework. And they talk about what I said earlier, very broadly, taking this understanding you've evolved from these various analyses you've undertaken at the broad business context level, and applying that to help you identify risks and opportunities to achieving your business objectives and your strategy objectives. And these risks are related to ESG related risks in the context of its latest framework. And then I take an inventory. I work out where the risks are, and then I decide how I'm going to manage them. And they state very clearly in this risk identification process for identifying ESG related risks that the Task Force on Climate Related Financial Disclosures recommends having a risk management process for identifying and assessing climate related risks, including whether an organization considers existing and emerging regulatory requirements related to climate change. So when this came out, this so-called TCFD framework was in the process of being developed. Its recommendations had come out. And what COSO have done is they've aligned their recommendations around risk with this framework in the context of identifying climate risks. And they are one of the many bodies who have proposed this TCFD as being a major body for looking at the reporting and management of climate-related risks within organizations. And that's why we focus on this in the last part of this week's lecture. So back to COSO's risk and opportunities identification. Take some examples. If we look at different types of areas where you might want to manage risks: strategic, operational, financial, and compliance, COSO offers us, in the context of ESG related risks, some specific examples of what we might be actually trying to manage and report on. So in the context of strategic risks, they talk about the shift of customer preferences towards products that are manufactured with ethical supply chains. That's a risk. Might also be an opportunity. They talk about growing investor interest in ESG issues, which have resulted in proxy voting against a company on a range of topics related to diversity, deforestation, and human rights. So these are risks that need to be managed. In the area of operational risks, they talk about risks from the increased cost of raw materials due to sustainable forestry practice requirements. They talk about how changing weather patterns and increased natural disasters might disturb operations and business continuity. Now, they'll be managed in different ways and reported on in different ways, but they're all examples of operational risks which relate to and emanate from the environment. And the focus here is on the impacts they can have on the organization. How can they impact us? Financial risks, increased taxation from carbon tax regulation, reputation impact and societal concerns due to a tax avoidance strategy the company has, or a lack of tax transparency. So outlining where are our risks in the context of our financial areas in the organization. And then in relation to compliance, well, there might be enhanced reporting requirements for greenhouse gas emissions and energy usage. We need to look at that and deal with it. And also, as we'll see in part 3, it may be that these TCFD disclosure recommendations become mandatory within a few years. So in many cases, an ESG-related risk impacts on several or all of these strategic, operational, financial, and compliance categories. For example, the human rights risks we talked about might be predominantly operational. However, some jurisdictions have compliance requirements relating to human rights in the supply chain. So you have an impact on both operational issues and compliance issues. So that's just an example that COSO gives us of specifics around these risks and how we might go about managing them. Also, COSO says, don't forget about risk impacts. And that comes back to what ESG risks we want to prioritize. And it suggests giving a risk rating to these risks, ranging from catastrophic, high risk, medium risk, or low risk. And it then gives us issues, quantified issues, that we should use to help us to assess when a risk is deemed to be catastrophic, high, medium, or low. So, for example, they say, set a limit to the financial loss that can come from a risk. Like, for example, look at a percentage of earnings before interest, taxations, depreciation, and amortization. Look at this EBITDA percentage and say, if it goes beyond this, we act. Or we look at more than a percentage impact on share price, although estimating that can be quite volatile. Maybe another area to look at is international negative media coverage lasting more than 6 months, that you can link to a certain percentage result in revenue loss. Now, you've got to get that association. That might be difficult. A more than a certain percentage level of employee turnover, which you believe is coming about because of a risk that you haven't been managing properly. So, threatened fines, litigation greater than a certain percentage of your expenses might lead to you to think of a risk as being catastrophic, high, medium, or low. So all of these, excuse me, elements, which are all quantified, are assessed in this particular example, and they illustrate to you the impact that a risk can have. And then depending on the percentages, you deem a risk to be catastrophic, high, medium, or low. This is just one way of addressing your risks in this area. I need data to assess these risk impacts. Well, that data can be primary data coming from within the organization, survey results, interviews and focus groups, or it can be also data coming from outside the organization. Internal organization data can come from sales performance data, surveys of employees or suppliers, data from supplier spend, water usage, greenhouse gas emissions, so-called hard data. Secondary data can come from big data analysis of certain indicators, where you track changes in external environmental issues, academic research where it's useful, bring in subject matter experts, third parties, interview them, look at government or think tank data, look at outputs from organizations like the Natural Capital Protocol, as it's called. So you'll have managers in place to look at this data and see how it relates to assessing impacts on the organization. So you can see it can be very, very detailed. And you can build up quite a complex and detailed set of data to support assessments of risk impacts and to help you manage these so-called ESG risks. So it's very easy to dismiss COSO's framework as it applies to ESG risks as opportunistic. But the guidance they give to organizations is actually quite specific in this context. Also, organizations need to decide when to respond to ESG related risks. So you might have a risk of increasing energy costs, impacting on operational costs. Well, what's your response? Well, you might switch fuel or adopt a renewable energy strategy to reduce reliance on fossil fuels that may be subject to a carbon tax. You might be at risk of community and NGO activity impacting business continuity, for example, in the mining and extractive sector. Well, then engage stakeholders, conduct town hall meetings, put in place hotlines, work out what these expectations are and how you can manage them, and how they lead you to maybe operationalize changes if you believe changes should occur if this risk is one you're concerned about. Risk of disruption to supply due to extreme weather. Again, think about this in terms of Taleb et al. What are the consequences? How can we react to this? Diversify the supplier base. Work with critical or strategic suppliers to develop business continuity planning. And this is back to Power's argument that risk management needs to be more about business continuity management in the context of an ERM framework. There's a risk of using an unfamiliar supplier, leading to product quality issues. That may lead to lots of issues around demand for your product and consumer preferences. So again, have processes in place for approved supplier listings and examine those suppliers, because that supply chain can be your weak link in the context of ESG related risks. So all of these are just examples of the guidance that COSO gives you. And then finally, if you can, when you try and manage activities in your organizations, can you see in any way if they're having an impact, if there are some outcomes coming from those management? An example that COSO gives, for example, is looking at the code of conduct for your suppliers, supplier management, supply chain management. So in this context, they have an activity whereby you look and see what percentage of your suppliers are being audited and passing an audit, indicating their code of conduct in their organization is sufficient. Now you can see here in this depiction the percentage of suppliers in this organization who have been audited successfully in relation to conforming to a supplier code of conduct has increased over time to almost 70%. Now an outcome from that might be in that supply chain a lost time injury rate decline. In other words, a decline in the lost time from injuries to employees in the supply chain. So I don't know if there's a direct correlation here, but organizations should be looking to see if the activities they undertake to manage ESG related risks lead in some way to some sort of reduction in risk, but also a reduction in the actual outcome that can have impacts for the business, because that's what the management of these ESG related risks is all about. So finally, on the communication dimension of the ERM framework, as we saw in part 1 of this week's lecture, we have a choice. We have all these frameworks: the CDSB, GRI, integrated reporting, the TCFD, which comes up now in part 3, SASB, the Sustainable Development Goals and application of those. But reporting is important. You want to get the message out there. You want to show investors in particular that you are managing ESG related risks that may have an impact on the portfolios they have, portfolios in which your company may well be prominently represented. But again, as we outlined in part 1, we have an issue with these frameworks, and this need for alignment is causing major concerns. And it's that need for alignment and that recent focus now on this task force for climate-related financial disclosures that's going to be the focus of the final part of this week's lecture. So in this part, we've looked at how the enterprise risk management of COSO, which we introduced last week and examined at the organizational and institutional level in the seminars, is being applied to the very specific area of environmental, social, and governance risks. The ERM framework, as depicted last week, has been adapted or aligned with ESG risk. And that's really what's going on in this context. Now, all you need to know is the broad issues, not the detail there about this process. Now let's go to the third part of this week's lecture to look at the most recent major development in this reporting and management of ESG-related risks, the Task Force on Climate-Related Financial Disclosures.